If you are sitting on a pile of cash in a traditional bank account, or if you've parked your wealth in a standard retirement fund, you are standing on the wrong side of the largest stealth wealth transfer in modern American history. While mainstream media has you completely distracted by the latest AI stock market bubble, the government has quietly activated a highly secretive playbook from the 1940s to erase $39 trillion in debt, using your purchasing power to do it. Here is the exact data they don't want you to see, and exactly how the smartest money in the world is protecting their capital right now.
Let's start with the ultimate distraction. If you turn on mainstream financial television today, you will see a market that is utterly euphoric. The S&P 500 is currently on a 9-week winning streak. If it closes higher this week, it will be the longest winning streak since 1985. The entire financial world is currently obsessed with the Computex event in Taipei, where NVIDIA's CEO Jensen Huang just unveiled the N1X, also known as the RTX Spark. It's a brand new super PC chip specifically designed to run local AI agents directly on your laptop, targeting Intel and AMD's market share. Retail investors are pouring billions into these tech stocks, driving companies like Dell and ServiceNow to record highs. We are seeing a market that feels completely detached from reality. But if you are an investor who actually wants to preserve your wealth, you need to look past the cheering crowds in Taiwan. You need to look at the silent alarms flashing in the global bond market and the commodity sector.
While everyone is focused on software and microchips, the physical world is sending us a massive warning. Crude oil has been stubbornly sitting at roughly $100 a barrel for over 2 months now. Why does that matter? Because oil isn't just what you put in your car. Oil is the cost of moving everything. It's shipping, it's plastics, it's fertilizer. At the exact same time, we just got the latest ISM manufacturing data for May, and it showed the biggest expansion in 4 years, hitting an index of 54. Now, on the surface, a manufacturing boom sounds great, but it is largely being driven by the massive physical build-out of AI data centers. You can't build a massive data center without concrete, copper, plumbers, and an astronomical amount of electricity. This is creating an intense supply shock. When you combine $100 oil with a sudden surge in physical manufacturing demand, you get sticky, aggressive inflation. The official producer price index, which measures what it costs businesses to make things, just hit 6%. The consumer price index is sitting at 3.8%, nearly double the Federal Reserve's target. This sticky inflation leads us directly to the $39 trillion elephant in the room. The United States government currently owes roughly $39 trillion in official debt, and we're adding about $2.5 trillion to that number every single year. For the last decade, this wasn't a huge problem because interest rates were sitting at zero. It was free money. But today, the U.S. is paying between 4 and 5% interest on that mountain of debt. Nearly half of everything the government collects in taxes now goes straight toward covering the interest on the debt before a single dollar is spent on the military, roads, or Social Security. The Congressional Budget Office projects interest payments alone will reach $2.1 trillion a year. The math has completely broken down. The U.S. government is quite literally borrowing money just to pay the interest on the money it already borrowed. It's a debt spiral. When a government faces a debt spiral of this magnitude, there are only 3 ways out. Option 1 is austerity, cut spending and raise taxes. In our current political climate, that is completely impossible. Politicians would rather kick the can down the road. Option 2 is to default on the debt. As the holder of the world's reserve currency, the U.S. will never do that. That leaves only option 3, the invisible tax. It is exactly what the U.S. government did in the 1940s, and it's called financial repression. After World War II, the U.S. debt to GDP ratio hit 106%, very close to where we are today. How did they pay for it? The Treasury Department essentially forced the Federal Reserve to peg interest rates at artificially low levels. They locked long-term bond yields at around 2.5% from 1942 all the way to 1951. They kept rates low, but they let inflation run hot, sometimes hitting 10% annualized. Think about what that actually means. If you hold a bond paying you 2.5%, but the cost of living is rising by 10%, you are losing massive amounts of purchasing power every single year. The government used the melting purchasing power of everyday citizens to slowly shrink the true size of the national debt. By 1974, that debt-to-GDP ratio had fallen from 106% all the way down to 23%. It worked perfectly for the government, but it was absolutely devastating for savers, bondholders, and anyone holding cash.
If you have capital to protect right now, you need to understand that this exact playbook is being deployed again today, but with modern camouflage. The new Federal Reserve Chair, Kevin Warsh, is stepping into an impossible situation. The market is pricing in a 51% chance of a rate hike by the end of the year to combat this inflation, but the government cannot afford higher rates on its $39 trillion debt. So how do they keep rates low while inflation is clearly burning through your wallet? They changed the way they measured the fire. We've seen this before. In the 1990s, the government introduced substitution bias. If the price of steak goes up, the government assumes you will just buy chicken instead, and suddenly they can report that food inflation is down. We also have hedonic adjustments. If a car costs $10,000 more than it did 5 years ago, the government argues that the car has better safety features and backup cameras, so you are actually getting more value, meaning the price hasn't technically inflated. And it's not just inflation, it's the jobs data too. We frequently see initial reports showing strong job creation, only to see quiet revisions months later showing the numbers were significantly weaker. The jobs data also counts the same person twice if they have to take on a second part-time job just to afford groceries. When institutions measuring the problem have a massive financial incentive to show lower numbers, the numbers will always skew downward. They need to show you a low inflation number so they don't have to raise interest rates, allowing them to quietly inflate away the national debt. But here is where the 2026 version of financial repression hits a massive roadblock. In the 1940s, the global financial system was completely different. Today, the U.S. relies heavily on foreign nations to buy our debt. And right now, the global bond market is breaking. Two of America's biggest lenders, China and Japan, are heavily dumping U.S. treasuries. At their peak, China held about $1.3 trillion in U.S. treasuries. Today, that number is down to $650 billion, the lowest level since 2008. Japan, our largest foreign holder of debt, has sold more U.S. treasuries in the first quarter of 2026 than they have in the last 4 years combined. Why? Because Japan is trapped in a doom loop. To save their own currency, the yen, from completely collapsing against the dollar, they are being forced to sell their U.S. dollar assets to buy yen. When our biggest buyers step away from the table, the U.S. government has to offer higher and higher yields to convince anyone else to lend them money. That is exactly why the 30-year U.S. Treasury bond yield recently spiked past 5%, a level we haven't seen since right before the 2007 financial crisis. If foreign countries won't buy our debt, who will? The buyers will ultimately have to be American citizens through pension funds, retirement accounts, and eventually the Federal Reserve itself, printing more money to buy the government's own bonds.
This brings us back to the stock market. Why are equities ripping higher if the underlying foundation is cracking? Because the stock market is essentially pricing in this exact scenario. Wall Street knows that eventually the Fed will have to print money or inject liquidity to save the bond market. And when the Fed injects liquidity, asset prices go up. But if you are deploying significant capital right now, you need to be surgical because the cracks are starting to show. Let's look at a company like MicroStrategy. For years, their corporate strategy has been to relentlessly buy and hold Bitcoin. But just this week, for the first time since 2022, MicroStrategy was forced to actually sell some of its Bitcoin holdings to cover preferred shares. When the biggest diamond-handed institutions start tactically selling, you need to pay attention to liquidity. Look at the AI sector. Stocks like Micron are up over 200% this year. Its relative strength index, a measure of how overbought a stock is, just hit a level we haven't seen since 1995. Now, back in 1995, Micron corrected by 40% shortly after hitting that level. While the earnings growth for these tech companies is very real today, they are generating mountains of cash. The valuations are leaving absolutely zero room for error. A massive amount of money is indiscriminately chasing a very narrow sector.
So, if you are a high net worth individual or simply someone who has worked hard to accumulate cash, how do you navigate this? How do you protect your purchasing power when the government is actively trying to melt it away? First, holding excessive amounts of cash in a traditional checking account yielding 0% is no longer a safe conservative move. It is a guaranteed loss of purchasing power. The smart money is utilizing a barbell strategy. On one end, they are locking in elevated risk-free yields while they still can. With the Fed trapped, short-term Treasury bills are paying over 5%. That is a safe haven that guarantees a return while you wait for market volatility to shake out the over-leveraged players. On the other end of the barbell, institutional money is moving heavily into hard assets and inflation hedges that cannot be printed or manipulated by the government. This is why central banks around the world bought over 1,000 tons of gold recently. They are moving away from U.S. debt and into physical assets. And we are seeing financial products adapt to this. For example, the Strategy Shares Gold Enhanced Yield ETF, ticker symbol GOLI, is up nearly 23% this year. It operates by holding 90% of its assets in investment-grade corporate bonds and treasury bills to generate a 5% annual yield, while using a futures overlay to give investors 100% exposure to the price of gold. It acts as both a shield against currency devaluation and an income generator. Furthermore, capital is rotating out of hyper-expensive consumer tech and into China-immune infrastructure and legacy value. As the global supply chain fractures, the companies that control physical manufacturing, energy pipelines, and irreplaceable industrial components will command massive premiums. The era of buying any index fund and blindly trusting the government to keep inflation at 2% is over. We have entered an era of financial repression. The cost of living will continue to rise faster than the official data admits, and the only way to survive the 2026 wealth transfer is to own assets that the government cannot easily inflate away.